Welcome, everybody, to today's webinar from 70 Investments on Mortgage Note Investing 101. Today will be a introductory session into mortgage note investing, how 70 operates as a company, and we'll also talk a little bit more about our fund and our offering. First, I want to start with a little backstory about me. I have been in real estate my entire career. I started in the mid-90s, and I've worked in construction, development, asset management. And throughout that period of time, one of the things that I've always mentioned or noticed was every project that I had to run throughout my career had to be managed through defined budget, timelines, schedules, risk mitigation, and outcomes that typically involves conflict-oriented work. And it was 10 years ago that I discovered note investing. And I was actually somewhat upset when I first found out about note investing because I knew there was private lending, but I actually did not understand or realize this existing on the secondary market. And based off of my entire background, it was such a natural fit for me to move into the space. And I started off investing like people, I've seen some names on here, are active investors, buying one note at a time. And one note led to five to 10. And then we started raising capital and doing some funds. On the fund side of things, we were doing 506Bs and Cs, which are typically accredited investors, and focused on timeframes and return profiles to see what fit the business model. And after doing 5 prior funds, we launched our Regulation A+ offering back in 2022. Actually, the company was incorporated in February of 2022. It's hitting 4 years. And we launched a Regulation A+ offering because we realized not everybody had access to these types of funds. Most people needed to be an accredited investor and needed $100,000 to invest. At 70, we wanted to offer this to the blue ocean strategy of accredited and non-accredited, with a $5,000 minimum, and take this exclusive asset class and make it available to the masses. So that's how 70 was born. We'll talk more about what we do in regarding into investing and primarily first position notes. That's what we'll talk about in this presentation. But I want to talk a little bit about who we are, which as a company. And when we were getting started, what we witnessed in this space was a lot of investors were starting investing on themselves. So I call them single investors who were buying one-off assets. And then on the other end or spectrum, there were the larger institutional players who were buying hundreds or thousands of assets at a time. And what I would deem is more of a top-down management style where they buy a portfolio and they would sell off the chunks of it. And typically they would externally manage or have a third-party company would manage that portfolio for them. And I viewed this as an opportunity in the space to build a company that focused on a bottom-up strategy where we're internally led, we're internally managed. We control our attorneys, where typically a lot of other companies may have their servicer do it. So we really want to focus on rolling up our sleeves and controlling the outcomes. And that's when we saw that opportunity. That's part of the reason of 7E, and I believe our success over the last 10 years is because of that internally managed, controlling the outcomes philosophy we have, which goes back to my experience in real estate of always being able to manage and control lots of vendors, contractors, and other vendors. As part of that, our mission, we do look to democratize this investment opportunity. I like to call it, it's not a net sum zero game. We can work with a borrower, keep them in their property, and also provide a benefit to us and our investors. And typically, based on these outcomes, we're not giving up any type of return to keep them. It's not as if foreclosure is more profitable than keeping with the borrowers in their home. It typically is vice versa. You're reducing risk, you're reducing legal costs, and you're able to keep that person in that property, which we believe does have some type of social benefit, and you're not doing it to impact others or taking anything away from others. So let's dive in. What is mortgage note investing? High level, it's an investment strategy where you are providing funds that are secured by physical real estate. Mortgage note investing, typically you're buying the loans on the secondary market. You buy them from whole loan traders, private lenders, banks, credit unions. Most of the loans we buy are from whole loan traders. They get pools from institutions that they put out to bid, and we can bid on one asset, cherry pick, or bid on pools of assets, depending on how they set forth those terms. Now, once you acquire that mortgage note, which is really just an IOU of somebody owes you money, and we like to buy those at a discount targeted to hit a specific yield, you become the lender of record. And as the note holder, you're now owed those future payments. Now, I'll give just a simple example for those who have owned real estate in the past and have gotten a mortgage on it. You sign the closing docs, that big thick packet that probably 90% of people actually don't read. You sign everything, sign your life away, and then you start making your payments. And then about 90 days after you've made those payments, you might get a letter in the mail that says, please now make your payments to XYZ. XYZ is a new company because typically your loan has been sold and there is a new lender. So this is not some, new phenomenon. Loans have been bought and sold, pretty much for as long as I have known. And, more than I think 50% of the loans actually get sold on the markets. Two main types of loans, performing and non-performing. I think they're very self-explanatory. Performing, borrower making payments. Non-performing, borrower is not making their payments. One of the interesting things that I'll mention about the non-performing loans is many people, when they get into this business, hear non-performing, or even people who are not in this business, and think non-performing is you miss one or two payments, bank's going to start knocking on your door and, try and foreclose on you or evict you or get you out of that property immediately. That's really the furthest from the truth. One of the things that we've witnessed and have known, banks tend to be a little inefficient in how they manage defaulted loans. Analogy I like to use is think of a tract home builder. Tract home builder, if they're building all the same homes in the community, just go from one to the next, just like a bank gives one loan to the next. The moment somebody says, can I have different cabinets? Can I have different carpet? Can I have different this? Can I customize this or change something? That change throws that builder off track because it's not within their systems and processes. We see that a lot as well from the institutions where they've got many aspects of their business streamlined, but when things aren't conforming, it throws it out of kilter, and then they may not have the efficiency to manage that properly, and in some instances, it might be better for them to dispose of it. That's where we step in and we acquire those loans and try and work with the borrowers one-on-one to what we call fix and flip the loan. Let's step back a little bit and talk about the size of the mortgage note industry, because people look at this space and wonder, what's your volume? What's your inventory? What do things look like? It's a $14 trillion industry. And statistics show there's about just over 50 million homes in the country with a first position mortgage. Based off of default rates, that's equivalent to about $400 billion in non-performing debt and about 1.5 million homes in default. So us as a fund right now have a little over 100 assets in our fund out of 1.5 million homes. From a volume perspective, in January, we saw several $billion in non-performing loans. And for us, we took that several billion, narrowed it down to about 200 million, and put in bids of roughly $50 million in assets, because our hit rate typically floats anywhere between 10 and 30%, depending on the seller. Some sellers we have better hit rates with, Others, it's a little more challenging, but want to show the scale of this industry that is out there, because this is not an industry that is small in any way, shape, or form. One of the top questions people ask us is, what causes distressed debt? What are the main reasons? Why do we see people default? And I think, most people would probably agree that somebody just doesn't wake up one day and says, I'm going to go make myself some toast and not pay my mortgage today. People don't volunteer to not pay. It's typically a result, cause and effect. The cause, many instances, job loss, a health issue. They couldn't go to work and they were in the hospital, or they had medical bills. Divorce, separation. Many people today rely on 2 incomes. Could go down to 1. That can have a major impact. Of course, the last one is, unfortunately, death. So these are primarily the 4 causes. And we usually will target the loans that, may have had a temporary job loss or some other type of situation that they can recover from, versus, on the death side of things, more than likely you're going to have to go take that property. We prefer, again, to try and work it out with the borrower. And that's a high-level view, the market, who we are, what we do. Now let's dive a little bit deeper and talk about acquisition and due diligence. Now, first, as part of the acquisition phase, I want to talk about what motivates sellers and why people sell loans, because this is a common misconception that only loans that you see out there are loans that have a problem or they have an issue. That is the furthest from the case. There's loans that are out there that are extremely high quality, and many of the reasons we see are staffing and labor shortages. Banks aren't staffed to manage non-performing assets. You ever tried to pick up the phone and call a bank and say, who runs your non-performing loan department? You get tossed around to several people, but you'll probably even have trouble getting to that individual. Ability to lend. A lot of these institutions have covenants that if they hit certain number of loans non-performing, volume, it might impact their ability to continue lending on those performing loans. So they want to get those off their books. And also, of course, during high interest rate periods, these non-performing loans that are written at lower interest rates, you might want to push them off because they know they can get a performing loan at a better rate. Today is a perfect example. Where were rates 3 years ago? 3%, 4%. Today, those loans are at, 6% plus. So where would you rather be lending, in the old environment or the new environment? Lenders also look to rebalance their portfolio. Some funds we buy from might be because the fund is closing. It's just so many different aspects of why people sell that it's not necessarily because it's a bad asset. And the last example I'll use is we bought a pool of assets once, and there was an asset in Montana. We don't do business in Montana because the servicer we work with isn't licensed in Montana, and we don't want to have to set up a whole new brand new servicing agreement with one servicer for one asset. And this asset was about a $50,000 asset. So we have partners that we've worked with in the past and said, hey, you interested in this asset? They came back and said, yes, they were interested. So we bought it, turned around, immediately sold it to them, and actually made a few dollars on the deal as well. So the key takeaway on this is, the motivation to sell can be driven by many different factors. And once you find a investor who is selling assets, what's the steps? It's very similar to, honestly, buying a house. The difference is, I'd say it's less formal. First, you get what's called a tape, which is a spreadsheet with information on it. Some sellers will provide a bid room that includes the actual documentation. Some don't. It really depends. But you bid off of that information, and it either gets accepted, rejected, or countered. And then if it's accepted, you have a due diligence period, similar like buying a house. You get an escrow period. We typically spend 2 to 3 weeks in a due diligence period. And then if everything comes up good, we'll buy it at that price. If there's issues, potentially, there are taxes owed on the property, we might discount it by the tax amount. It's called fading the bid or reducing the number. Similar to buying a house where, hey, you realize a hot water heater's gone. You want to negotiate that in. You do it at that time, and you close. And once you sign those documents, you then get from the seller the proper paperwork to record. So you are the lender. Now, bidding on a tape. This is just an example of, kind of some of the information on a tape. Of course, for confidential purposes, I don't provide addresses or other types of documents, but kind of gives you a full-blown picture of what's their principal and interest payment, their interest rate, where is it illegal, next due date, which is basically how far they're behind. And on this tape, you can see some of these loans are, one of them from 2009, some of them anywhere from, 6 to 10 years old. And that is not uncommon to see loans, that old on some of these tapes. And then it includes other information, but what we do is we color code and think of a traffic signal. Green is a go, red is a no, red is stop. We're not going to look at it anymore. And yellow is, we'll take another look at it, but initial pass, it's kind of in that gray area, because what we like to try and do is target, what I'll say is the top 1% of the loans that fit our portfolio and what we do. And that's, again, important understanding of what we do and what fits our portfolio might be very different from somebody else. There's some investors that want to foreclose and take that property. What we bid on and what they bid on, two completely different things. So let's talk about first how it works. First, you buy a loan, on a single family house. And really, there's two paths you can go down: through the borrower or through the property. And if you go through the borrower, and we'll talk about some of these strategies on next slide, typically you negotiate the payment with the borrower, it generates cash flow, and then typically 3 things happen. You can sell the loan back on the secondary market at a performing loan. Borrower may sell the home, and then of course you get paid off, or the borrower may refinance. And in the different market cycles that we have seen, these outcomes have changed. During COVID, option 3 was what we were really seeing, was borrower refinancing and paying off the loan. Prior to that, we saw more people selling their property, and also us, selling the loans. Today, what do we see? Typically those top 2, not seeing a ton of people refinance. Why? Because of where rates are at. The other strategy is taking ownership of the home and then exit through the property. You can take it through foreclosure, deed in lieu of foreclosure, those are the primary 2. And then of course, you can sell the home, sell it on seller financing. You control that property, so you get to figure out how you want to liquidate it. Mario, I saw a question. I'll get to that in a minute. So how do we manage the process? This is, again, back to one of the most important factors of mortgage note investing. We typically start by sending a demand letter on our non-performing loans. Why do we do that? Because how many times do you receive a letter in the mail that you don't even bother opening, you rip it up and you throw it away? Now, how many times do you get a letter in the mail that says from the law offices of ABC, and do you rip that up and throw it in the mail? Very big difference. So sending it from a legal gets people to start communicating. Get that borrower communicating with the servicer, then we work with the servicer to come up with that resolution. And typically that will start with a trial payment plan where I call it's like putting them on training wheels. We'll make you put this much down, start making these payments, And if you can get through to the finish line, you modify the loan. And then once it's modified, we'll typically season that loan, meaning we'll hold it and collect payments for 6 to 12 months. And then we'll sell that on the secondary market. We have case studies we'll talk about in a few minutes that illustrate this process. And this process doesn't always go as planned. Sometimes they can't qualify for that trial payment plan. Sometimes they can't afford the property. And that's when we also have the conversations with them to try and have the servicer give them the options of, hey, we might want to look to sell this property because if it forecloses, what would happen? Typically, it's sold for less than its actual value compared to putting a house on the market where people can get inside, see it, get financing on it. Your buyer pool is much larger if you can get them to look to sell that property. The other aspect of mortgage note investing that gets extremely complex is bankruptcy. And we're not going to dive too deep into bankruptcy, of course, on this call, but just understand that there's two types, Chapter 7, Chapter 13. And Chapter 7 is a complete liquidation where borrower just wants all their debt wiped from the slate and start fresh, start clean. Sometimes they may even want to get that house sold. Sometimes they may want to keep the property, which then you sign what's called a reaffirmation agreement, which means that debt is back. They now owe that debt. Now, what's interesting about Chapter 7, and I see this happen a lot where people, the misconception is when somebody files Chapter 7, that note is wiped. They don't owe you the money anymore. So, if I gave my house, bought the note on my neighbor's house, and they file Chapter 7, I can't collect any more money from them. Now, that doesn't mean they get a free house. You still can go after the property, you just can't go after them for the payments. That's why having that security instrument, that mortgage deed of trust, is so important. That is your safety net, that blanket. Chapter 13, different story. That's a restructuring of the debt, typically over 3 to 5 years. People got too crazy on credit cards, living the lavish lifestyle, buying those fancy expensive cars, buying a house, not knowing how much it actually costs to own a house. Next thing, realize, oh man, somebody, significant other may have temporarily lost a job. And all of a sudden it's like, I can't afford these payments anymore. So what you do, they file Chapter 13, they restructure that debt. And that is a plan where we love Chapter 13s. They're very complex, but it's an open book. You get to see every bill that person has, what they're paying, how they're paying. It's complete transparency to see, really underneath, the mattress of what is going on in there, how much money that they do have. Because let's be honest, how many people, when they fill out something, let's call it a package, and they say, how much do you spend on gas every month? How much do you spend on electric every month? How much do you spend on food every month? How many people actually accurately know that number, or you just put a number that guesses? In the Chapter 13 plan, you really get that skimmed down because they have to open up, what they're spending and how much they're making. Now, as I mentioned earlier, you've got those different exit strategies that we talked about through the borrower and through the property. And the majority of our loans, we typically exit through the borrower, whether we're selling it on that secondary market, accepting maybe a short payoff for them selling the property, or having them refinance that loan versus through the property, which is the foreclosure, deed in lieu, or, foreclosing and then selling the property back on that market. And I, for one, am biased where I want to go through that top line or through the borrower. Why? Because you've got legal and timeline risk. If that borrower is in default and you have to go through foreclosure process, depending on whether it's a judicial or non-judicial state, meaning judicial, you have to go through the courts. Non-judicial is much faster, but if you're in a judicial state, go through the courts. That time frame, you can't control. And a perfect example is we have a loan on our books right now that is in foreclosure and we have to have mediation. and we looked to schedule mediation after the beginning of New Year, early January. We needed to, set up mediation with the borrower's counsel. Now, the borrower's counsel wasn't available until March. We were trying to get it done in January. They're like, oh, we'll do it on March 5th or whatever the date is. It's coming up. But there's 2 months of time that, we have to wait to work something out. Fortunately, in this loan, go back to that investment to value slide, our investment is about 50% and there's equity in the property. So time in this instance is not hurting us because it's accruing that interest over time. But if I was investing where they didn't have that investment to value, that interest isn't really getting you anything because you've already maxed out on what you're going to get. So Mario asked, for investment to value, do you analyze all markets and adjust or have blanket 50%? How do you keep up with current market values where you invest? Great question. We analyze all markets and look at things like home price index, home valuation indexes, how homes have looked over the past 12 months in specific markets. Is it a appreciating market? Is it depreciating? How much is it depreciating? What is going on in that area? And within our model, which is basically another term for a really fancy spreadsheet that I spent way too much time building, we analyze things based off of locations, state, and also evaluate based off of values. And we might discount numbers or property values based off that. So an example, I'm in Northern Virginia. Let's say we think it's going to depreciate by 5% over the next year and it's a $750,000 property. We will model that number based off of $712,500 property. We discount it that 5% to $37,500. And, okay, if the property is worth $712,500 when we think we're going to exit, then, we take the realtor commissions and everything off of that number. And we typically will underwrite based off of foreclosure. And if we can work something out with that borrower, typically that is a better return for us. So hope that answered your question. And lots of reading, lots of research is how you keep up. Actually, Zillow actually, forget about a Zillow estimate. I am not backing a Zillow estimate. They are the furthest thing. They're extremely far off. But what Zillow does have in states that report housing data do have ZHVIs and other types of information that other sources can produce as well that talk to you more about market by market areas. Now, last thing I'll mention before we dive into the case studies is if there's a property that we think is worth $500,000 and we get it under agreement and we go buy that property and estimates come back and we were off and it's only worth $400,000 plus it needs new siding, new windows, or a new roof, we get an updated valuation from a third party called the broker price opinion. And then we get that to the seller and say, hey, look, this price is not what you think it is. And sometimes they rework the negotiations. Other times they won't. Example I'll give, just last week, we were doing due diligence on some assets. They had a valuation number of $400,000. They did not give us all we had was that spreadsheet. After we got all the information, in the file they gave us, they had an updated evaluation of that property of $375. I was like, oh, this is interesting. And then we went and did our own evaluation and the numbers were coming back because of the property condition that it was probably worth about $350. We went back to the seller, showed him this, and the seller basically was like, I still think it's worth $400. And we're like, well, we can't pay what we're going to pay because that value is not what we believe it is. So that deal fell apart, and that happens. Somebody asked, are you able to do a full inspection before closing? No, you cannot. You're trespassing on somebody's property. So we have somebody go buy the property. They can, from the road, take pictures of the side, the front of the property. Think about a Google Street View. A current Google Street View is typically what we get. But what we also do is have them fill out a report, because a photo in this instance doesn't tell the entire story, because sometimes they may see certain things that the photo is a little unclear in the photo. Like, yes, this roof is really old. Now, there was a broken window that was tough to see in the picture, or there's trash on the side of the property, or many different factors that may come into play. But you can't step on the property or knock on the door and basically like, hey, can I come look at your property? And then someone asks, do we sell reperforming notes direct or through third-party platforms? We do both. We have ongoing lists of assets that we do sell, but we also sell certain pools also out to third parties. Case studies, one of my favorite components. Oh, this Denver story. I have shared this one probably 100 times, because this is what I'd say our bread and butter. And I say that from the due diligence side through the outcome. In this instance, the borrower was about $25,000 past due on a $400,000 property, and they had equity in this property because this was an older loan. And we like to buy loans that were originated pre-COVID, because what happened since COVID, people may have paid down the mortgage slightly, or even if they didn't pay a penny on their mortgage, home prices have skyrocketed. So something that may have been 80% LTV back then, now it's probably 40% LTV. What's interesting about this was a pool we bought where the prior lender did minimal effort with the borrower. They drafted the demand letter. They never sent it. It took them 9 months to send out a package to the borrower to see if they'd qualify for modification. The borrower offered the lender same deal multiple times, but the lender never responded. And in one instance, actually, and I actually chuckle when I say this, they submitted the package, and by the time it made it through all the red tape with this lender, the information was more than 90 days old, so it got rejected, because the lender had to have the information current within 90 days, but it wasn't current because they took so much time to review it. Borrower offered us, when we bought the loan, offered us several $1,000s down, which we got. Then they stopped paying shortly. Then we sent that demand letter. And most likely what probably happened is they played this game previously with the same or other lenders of, oh, we'll give them a little bit and then kind of they'll go away for a year. That's not us. We stay active, and kind of, again, operational excellence and management is what we want to focus on, and staying on course, focus on schedule, timelines, budget. So we went back to the borrower, said, hey, you gotta keep this thing going. They agreed. They signed that trial payment plan, got them the paying, had the borrower make some payments. We modified the loan, then we sold it back on the market as a performing loan at a premium from what we bought it from and the money that we collected. There's another loan, very similar, where we acquired this loan and borrower was over a year behind. Initial outreach, not successful. Of course, get that attorney, send that demand letter. Took a little bit of time for the borrower to finally be responsive, which is par for the course. Don't think that the moment you send a demand letter that you're going to get a response the next week. If you get something within the first 90 days, you're winning. We got them signed a trial payment plan. Borrower ended up, as part of that plan, mentioned, hey, I'm getting an annual bonus. Can we work something out where when I get that bonus, I can give you a bigger chunk of money? And we said, yes. Borrower, gave us that money. We had the loan. Borrower started falling behind a little bit during the year. Got the attorney back in play, kind of, recycled that same story where got them again with the bonus and got them reinstated. And after we got them reinstated, had somebody who liked this area and wanted notes in this area. We ended up selling it off to them. And I always like to show things we don't buy, because it's easy to show you kind of the cookie cutter stuff, that way you target, but nobody really talks about the loans you pass on or why you pass on them. And this was a non-performing loan that came across our desk. It was actually a short-term loan. It was a bridge loan that had matured. And as you can see, this property was in fantastic condition. It was owned by a former NFL football player. And, we had the spreadsheet. So we bid off of the spreadsheet. Then when we got it accepted, we got the files and started looking through the files and then ordered title report. Whew, this one was a crazy story. The borrower was an LLC that had two members who were college buddies. And one of them was an attorney and the other one was a contractor. The attorney was allegedly signing as power of attorney for the other borrower that the other borrower was not aware of. But what was interesting was the contractor was claiming it was fraudulent. And if you look at the documents, usually if you sign power of attorney, someone signing power of attorney, they usually will sign their name and then, power of attorney is their title and attach the power of attorney. This person was actually signing the other person's name, which didn't think that was legal, but we'll let the courts decide that. There was also multiple loans. There was a title claim because of that claim. This collateral file, 3Ps, the person, the property, predicament. The property and the predicament were just completely mind-numbing to think what was going to be the outcome, which is eventually you're going to get paid, but you'd only get paid probably what title insurance would cover you, which was the original loan, which this loan, because I haven't been paid in so long, was well above that. And this would take forever to resolve. And as of today, which is February 18th of 2026, this is still tied up in legal and still doesn't even look like it's close to an outcome. So because this had significant title issues and you would eventually get paid, but it is such a mess, we passed on this. And I always recommend to investors, don't fall for, the HGTV homes as your notes, meaning, wow, this would be a beautiful home. Yes, it is. But, do you want to deal with 3 or 4 years of title claim issues and letting all your money sit on the sidelines, waiting for legal to resolve this in that title claim and in the courts? Again, operational excellence and control. So now I'll talk about the passive option of note investing. Now you got note investing 101 ingrained. At 7E, we have multiple offerings. We have a Regulation D 506C offering that we call it our profit sharing bond offering. This is only open to accredited investors. It's a 5-year hold period where if you are a D5 investor, you get a 9.5% coupon, but 10% of the company profits will also be distributed through this bond class for the first $25 million of investments within this class, which is approximately right now about 60% filled, I believe. Then we have an E5 class, which is just a straight 5-year, higher coupon, excludes any type of profit sharing. We've had people interested in both, personal preference on those. The E5 does have a $500,000 minimum. The D5 has a $100,000 minimum. So this is our accredited investor offering. And one of the reasons for this passive side of things, and what we like to target, of course, the 7 reasons for 7E for our investors is, those risk-adjusted returns and diversification. You're investing in a portfolio of loans. You're not investing in a single asset where if that loan, you live and die by that one loan, you invest in the pool of assets. So important question to ask if you're investing in the passive side, am I investing in one loan? Am I investing in a company? And if it's one loan, what happens if it pays off? Do I have to go find a new one? Do you automatically place one? For us, we try and keep things extremely simple. The KISS method, keep it simple, stupid. It's what we like to say. Monthly distributions. We provide monthly distributions to our shareholders and bondholders. Non-correlated to the stock market. We believe that this mortgage market, when you look at the returns in the profiles of defaulted loans, there's very little, if any, correlation to the actual markets. It's an accessible investment. We'll talk about our non-accredited offerings in a moment, but it is open. We have investments open to credited and non-credited, as well as self-directed IRA accounts. One of the major factors that we also have within our offering is we do not have K1s. And anybody who is a passive investor who has to deal with K1s knows every time you hear the word K1s, you have to take that deep sigh like I just did, because K1s are a challenge for an investor to get them on time, get them correct. 1099s, end of January, they are out the door. Our investors already have all their 1099s. It's a passive investing, hands-off investment strategy. So you invest, you monitor your sponsors, but we like to say you don't deal with tenants, toilets, termites, in regards to if you're more active, whether you're being a note investor or a real estate investor. Proven leadership and track record. As I mentioned, I've been in real estate for almost 30 years. I've done over $1 billion in real estate development and construction. I've done 750 plus note deals. We've managed prior funds. And during that time, we've never missed a distribution as of now January of 2026. And the differentiator, that in-house team and experience, our investor relations in-house, our asset management in-house, and allows us to, again, operational control and look to control those outcomes. We have calls monthly or biweekly with our attorneys. How many servicers that people use have those calls with their attorneys? They don't. So having that in-house team that is focused and being able to answer the questions and provide timely responses to us is such a critical component of any investment strategy. Why a mortgage note fund? Talk about potential cash flow without the headache. Looking to earn distributions in varying market conditions. If you look at mortgage note investing and you look at default rates, now I think everyone can say stock market kind of goes up, down. Last few years, it's been going up. Number of defaulted loans, if you take away 2008 to 12, which you got to throw, such a global event, default rates pretty much have been pretty consistent. In returns within funds, of course, our funds have been pretty consistent. Whether it was COVID, pre-COVID, post-COVID, we've been through varying different cycles and be able to produce very similar results. You're also backed by collateral, backed by real estate. Shouldn't be going anywhere from that standpoint. And if you insure it and make sure your taxes are paid, it's very difficult to lose that piece of property. And then the versatility, numerous exit strategies. And we always like to say, if you drive through any major city, who's got the tallest building? Probably a bank. Rockefeller strategy, if you've heard of that before, control everything, own nothing type philosophy. You don't own the property, but you control it because you're the lender. And then if you do have to take the property back, you can sell it, you can rent it, you can sell or finance it, you can lease option it. We don't have debt in our portfolio. So when you have an asset that doesn't have debt on it, gives you so many more options in that versatility. Then lastly, the exciting announcement. As we mentioned, we talked briefly about our Reg D bonds offering. We were notified late Friday evening that our Regulation A+ offering, open to accredited and non-accredited investors, was qualified by the Securities and Exchange Commission. So we will be launching that very, very shortly. We will be having a webinar on March 11th to share the terms, the process, and dive deeper into that Regulation A+ offering. I will say, over the last 4 years, we've had over 1,000 investors in our fund, and we've spoken to many of you, if you are a current investor, or if you've spoken to us, even if you're not an investor, and gotten feedback. And we took that feedback that we got from investors to implement that feedback into this offering to provide varying options within this offering. So we are excited to announce that is qualified, and we are getting ready to launch our new Regulation A+ offering. With that being said I'd be an hour on this and basically hit that 1 hour, but I'll leave a few minutes for questions and answers. Oh, good question. Can you legally utilize drones to examine the exterior properties you're considering purchasing the notes on? If so, do you? No, we don't. Legally, can you? Great question. We don't. I'm not sure if you can fly a drone over property, but if you were in the street in a public area, you could, I'm sure, fly a drone, but I don't know the legal ramifications of flying a drone over a property. And there are some companies that do that, but it's very costly. How many team members do you have on your team and experience? We have a team of 12. We've had staff we have some recently hired staff, as well as staff who've been here from the outset. Our investor relations team, we've got 2 FINRA licensed individuals on the investor relations team, as well as a 3rd asset management team has been here from the outset. Our operations team, our accounting team. So operations has been here from the get-go. Combined experience is well over 100 years in whether real estate, finance, or corporate exposure. What typical yields are you looking to hit with each property? Another good question. It varies. It depends. Again, you have to weigh in a lot of risk into that component. Is, judicial states versus non-judicial states might be different. On a non-performing loan, to give you ballpark numbers, we model somewhere between 20 and 30% is what we would look for on a non-performing loan. The minimum for, so our Reg A offering, someone asked the minimum for non-accredited investors. On March 11th, we'll have a full webinar explaining all the details, everything about that offering. I'll give you a little teaser that the minimum is the same as our last one, which is $5,000. And you can use a self-directed Roth to fund that investment. You can use just a regular self-directed IRA to fund that investment. We have worked with, I believe, over 25 custodians who we've worked with in the past, who we have direct lines of communication with. So we are very familiar with that process and can assist you in getting the investment across the finish line. If any of the non-performing notes cannot be turned around to make them performing, do you ever sell any of those properties that are going to foreclosure? Yes, we do foreclose on occasion. I don't have the exact percentage. If I were to throw a dart at a dartboard, I would say it's somewhere between 10% plus or minus that go to foreclosure. Now, we don't own the property before it goes to foreclosure, so we can only sell the note, not the property. But what we do sometimes do is we might find a local investor and let them know we're foreclosing on that asset, and we have sold the property to them and then financed the property to them so they could get it rehabbed and then turned around. We have sold it directly to them, letting them know what our bid number was. During COVID, because of the equity, if we did have a foreclosure, those would usually be sold at sale. And then sometimes we do have to take a property back and we may sell it as is, or because of my background experience in construction, we have connections across the country where we can get somebody in to provide and renovate the property to bring it up to a condition where it is financeable. I want to thank you all for being on this webinar. If you're interested in speaking to anybody on our team, you can use this QR code here to scan it and book a call. And I'll leave that up for a minute, and then I will then just quickly get into final disclosures. that I will leave up on the screen. I'm not going to read this entire disclosure. And lastly, if you can't scan that QR code, you can email us, invest@70investments, or call us at the number below. So, or go to a website, and we'll be in the very near future posting more information about our future offering, but also, again, March 11th, make sure to join us and we can launch and tell you more about our Reg A offering. So thank you all for being here today. I appreciate it, and enjoy the rest of your week.